Welcome back. You're with Money, 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 and we're discussing equity mutual funds with our guest this week, Harshvardhan Roongta. Harsha, so we've discussed the broad contours of a medium risk portfolio. Now I want you to give us some examples. Viewers should have some idea and choice about the 60% component of this portfolio, which you say should go in large cap funds, 30% which should be mid caps to help you give the advantage of, a mid cap becoming a star, and the residual 10%.
Well, if you look at the large cap categories, one portion of that could go into passively managed, which are index funds. So, you could choose an IDFC Nifty fund, or you could choose an HDFC Sensex plan. Basically, these would invest and replicate the Nifty or the Sensex. So, you're investing in large cap companies which form a part of the index. The actively managed funds, you could choose the fund house, which is ICICI, which could be HDFC, which could be Birla. So I could name a few schemes if you wish. ICICI, you could invest into the focused blue chip fund. So this has a very nice focused, outlook, and they concentrate on the portfolio and they look at them, pick up only companies which are really very good.
Okay.
The other you could choose would be a Birla Frontline Equity that has some portion of mid cap also though in it. It's not a pure large cap, but it does have a large component into the large cap companies. A Franklin India Blue Chip Fund is another which you could look at to invest into the large cap category. So there are 3 or 4 names.
And what are the average returns that these schemes have given over the last 5 years?
A large cap portfolio over a longer period of time would, if I would say 10 years period, would be about 14 to 15%
return.
So they have given compounded returns in double figures and well enough and high enough to beat inflation comfortably.
Okay, so let's now come down to the mid cap fund selection, which is usually slightly more tedious and time consuming.
Well, in the mid cap category, again, if I how do we like to choose the schemes? We first shortlist a fund house, because we need to see how a fund house has performed on an overall basis, not just scheme. A scheme could do very well in a short period of time merely because of luck factor as well, because they might have just picked up something which has simply worked in the last 1 year. So when I look at fund houses, I would say the top 5 fund houses would offer you the best of the schemes available, the fund management skills that we talk about also. So an ICICI Value Discovery would be one, an IDFC Premier Equity, or an HDFC Mid Cap Opportunities. Now, so these are the companies, these are the funds which have done extremely well and have basically seen different market cycles. So if you have seen different market cycles, you tend to have learned a lot, and they have a long history, so you can obviously bank upon their expertise over a longer period of time.
Now, the last 10% of this medium risk equity portfolio, where you also discussed perhaps overseas funds, and we have a query. In fact, Vikas Vishwakarma tweeted to us, and he said that he wants to get an idea about sector-specific funds, whether it should be IT, FMCG, banking, infra right now. So, I mean, just your thought on, since this is, let's say, the most volatile part of this portfolio, what sort of schemes should one be looking at?
What is important is that you need to understand the sector in case you're choosing to invest into it. If you do not understand it, then a diversified fund is much better. Yeah. When we talk about international funds, you have to understand why are you investing in another geographical
another country altogether. Yeah,
you're investing because you want to de-risk your investments from only the country in which you are currently investing into. Secondly, there is a foreign exchange play that comes into action. If you're investing in another country, then the foreign exchange fluctuations also affect the returns on your portfolio.
Sure.
Then there are certain companies which are global MNCs. If I could name some companies such as a Google, if you have to invest into Google, we all are consumers of Google. If you want to invest into Google, how do you invest into that? So there is no way you can sitting in India, or they're not listed in India.
So which are the schemes that sort of appeal to you?
Yeah, so the Franklin India has one scheme which is a feeder fund. So when you invest into this fund, this basically goes and invests into a scheme in the US. And the US fund will have a bunch of companies that they invest into, which could be Google, which could be any other company for that matter.
Fair enough. Now I want to come down to the costs involved and the taxation involved. And we know that there are no entry loads anymore because they were abolished several years ago. But there is a bit of a small element of a transaction tax. Also, exit loads, how do they vary across schemes? What are the costs that an investor should keep in mind as he's going into a mutual fund investment?
If you're a new investor, then there is 150 rupees that has been levied to you, which is also staggered over a period of 4 SIP installments. Or if you're making a lump sum, then 150 rupees is debited. If you're an existing investor availing the services of a distributor, there's a one-time 100 rupees levied onto your investment. So that is a very small charge. That is a transaction charge. When you talk about the other costs, so there is a fund management charge.
The expense ratio.
The expense ratio. Yeah. So you're giving your money to a professional to manage. Now he or she is going to charge you some kind of professional services fee. So the fund management charge is one which is levied by the fund house, the asset management company. So which is in an equity fund would be between 2.5%, or it could go up to 2.75 or 3%. So broadly, I would say currently the expense ratio is between 2.5 to 3%. So that's what is levied on your funds.
You know, last question before we start taking up your queries. There is a fair amount of mis-selling that's still prevalent in this mutual fund industry, especially for those who are new investors. There is some move, I think, to disclose the element of distribution commission as well, but nothing is very clear about whether that will actually happen or not. What are the red flags that a mutual fund, first-time mutual fund investor should keep in mind as he's going about deciding where to buy the fund from?
Well, one would be obviously you can verify the qualification of the person who's coming to advise you. So that would be one starting point as to what is the qualification. You don't go to a doctor and you know who's not qualified, right? So you need to check the qualification of the person who's coming to advise you. Second and most important is that if somebody is giving you free advice, you need to know why is that person giving you free advice. Is there some other form of remuneration that he's getting?
And so that is exactly what is not very clear right now, because those disclosures aren't in place.
Well, the commission rate, if you mention on a product, if you're talking about how much particular commission is he getting on this particular sale, that you can ask the distributor and he's obliged to let you know as per the regulations. Now the point is, if a distributor is getting a commission which is high on a particular product and is pushing that to you, and vis-a-vis another product in which the commission is less, an investor can definitely ask, why are you not giving me this product and why are you only suggesting this one? So when a person will start giving explanation, you will definitely know what is right and what is wrong. So I think this basic stuff, if you keep in mind, most importantly, an investor should know, how is the person advising me earning?
Okay.
Is the investor paying for his advice?
Yes.
So if you are paying for the advice, the person is going to be neutral because he's going to talk in your interest.
Absolutely.
In a situation where you're not paying him a fee, then you need to find out how is he getting remunerated. So that could be in the form of commissions. And if it is in the form of commissions, then you need to be cautious whether he's pushing a product which he's getting highly paid, or is he not, is suggesting something which is good but not being paid well. So that bit of exercise you will have to do. There's no other choice.
There's no other way around it. Absolutely. We're going to take a quick break on that note, but when we come back, it's all about your queries on equity mutual funds. So stay right there.